Welcome back. You are still watching Metropol television. Just before we went on a break, we were looking at that particular growth. Let me bring in Faith Atete, Senior Research Economist and CBA. Faith, yes, let's talk about that then. If 30 banks in the country are only accounting for 13.1% of profits before tax in 2020, and 9 banks taking 86.9% of that, is it time then for us to bring forth the conversation of let's debank the country?
Thank you, Elijah. That is certainly a conversation that has been ongoing within the industry for quite some time now. Yes, there is some evidence of a concentration within the banking sector. And theoretically, it's always assumed that when an industry is concentrated, then you have in this case the banks, or rather the class of the group of banks, who with the majority of that wallet share have more pricing power. They kind of set up pricing for the rest of the industry. Whether there's evidence for Kenya, I think it remains subject to further research. But certainly there is merit in decentralizing this. If you can have more, rather lesser banks with more better distribution of, the wallet share, and then the person who tends to gain is the normal money, the person who comes to bank to borrow, because then you intensify competition. The banks are incentivized to invest more in efficiency, and of course the benefit trickles down to the borrower. So there is merit in that. Like I said earlier, whether we see progress towards this, yes, there's been some steps towards this. The regulator is very encouraging. The players do appreciate there is need for this, but yes, it's still a free market, and unless, of course, you make it a bit difficult for banks, I think for the smaller banks, I think they'll still want to be part of these markets. And it's still a significantly huge market, so any player will still find it profitable, however small, to still be within this space, as long as you have the right business model, which focuses on the mass in this case, because I think the corporates are well banked. Where the opportunities still are within the mass market, and anyone with the right business model, however small your balance sheet is, can still benefit from this. So consolidation is still far out for us, but I think we are making progress towards it.
Pretty much. Let me come back to the studio and talk to Abraham on that as well. Abraham, yes, indeed. You hear what Faith is saying. Yes, despite you might be a very small bank, but you have your pool of clients within the economy. Your balance sheet is still going to make sense at the end of the day. But this coming at a time when the big boys, let me just speak of Equity Cooperative and KCB, they've been looking elsewhere for regional investments, because it looks as if this space is already crowded for them to even think of expanding even further within the Kenyan economy. But when you look at these numbers, 86.9% of just 9 banks have a larger concentration of the profits before tax, and 30 of them just taking 13.1%. Should we bring that conversation of debunking the economy to the fore? But when you look at where we are, we've seen exactly what the Central Bank of Kenya is trying to do. Are we at that point where we say, well, we can't add any other bank because then these numbers will not make proper sense?
No, I agree with her. I think there's one, everybody has their niche. But I think the point to make is the regulator must ensure that everybody is able to play in their field. And he has also alluded to something that in any market, if the regulator is not very, very careful, in any market, not just the banking sector, there's a tendency to move towards cartels or concentration, where we have a few players calling the shots for everybody else. It's not just this market, any market. In most economic models, if you look at them, unless there's intervention, there's a tendency to concentrate between a few guys who control the rest of the place. What you'd call monopoly. Now, in Kenya, why are the big boys going elsewhere? I think they're choosing to adopt a blue ocean strategy. That the DRC has only 5% banked. It's only a 5% banked market.
Yes.
So there's very little effort to grow your market there than in Kenya, where you really have to, most of the time, for you to get a client, you're probably getting them off someone else, or somebody is multi-banking.
That's it.
You see, so maybe it's a decision they're making internally. They're saying for the kind of capital we have,
yes,
we can go elsewhere and take advantage, because a fast mover advantage, like you see what equity has done to DRC.
Yes,
it will pay off big time, because by the time everybody else is rushing there, they'll find them there. So with the Kenyan market, yes, is consolidation also the solution? Maybe not.
Yes.
Because all the banks that are there, maybe save for one or two that are maybe going down, everybody else is still making their money. Their boards are happy, their shareholders are happy, so they have their niche. So I think we just let it be. And anyway, if somebody will only stay in business if they're in business. So why are they staying on? They're staying on because they're making some money.
Yes.
But at the same time, we should ensure that there are no unfair practices that will inhibit their growth, or that will give a due advantage of the big guy over the small guy.
Yes.
Remember, in any regulatory environment, the regulator is there to protect the weak from the strong.
Pretty much.
Yeah.
All right, let me cross over to George. George, just before we went on the break, you were mentioning the exposure points for the smaller banks in the country. I mean, do you think those exposure points would worry us so much, George, to the point that we're saying, well, we need to reduce the number of banks within the country more and more?
Elijah was talking to you about the stress testing results, and
yes,
just to put it simply, I think the smaller banks are more at risk to suffer in a space where we were last year and where we are today.
Yes.
If you look at the banks that have failed before, we talk of Chase Bank that went under, and the Imperial Bank, of course. Those were tier three banks. And Elijah can tell you that if nothing is done, probably Spire Bank might go under in the next 1 or 2 years, because
yes,
they have flouted all the CBK ratios as we stand today.
yes.
So my opinion is that amalgamation or these banks coming together to have a bigger enterprise is the way to go, and that is what central bank has been pushing for. You saw CBA merging with NIC the other day, and you can see the results that are coming in after that merger. The same to KCB and NBK,
yes,
and even Cooperative Bank, and I think Kingdom Bank. So in my opinion, I think that is where I foresee the banking sector going. This is not a very easy sector. It's a very tough sector, and it requires a bit of muscle for you to be able to survive some of these shocks. If you look at our market vis-a-vis our peers, you look at the number of banks in, say, Rwanda or in DRC Congo, then you realize that at 43 with a population of 50,
yes,
then probably our banks. The other bank I told you that was in Ethiopia. Ethiopia, I think 10 or 15 banks with a population around 100 million.
Yes.
So if you look at our case vis-a-vis our peers, then you realize that we are overbanked. And that is what brings some of these tier 3 banks to go under. And when they go under, Elijah, they go under with depositor savings. They go under with quite a number of people behind them. So to me, I think we should look at maybe having between 15 to 20 strong banks in the economy that can even look across in the region what Equity has done, what KCB has done, and what the likes of NCB, I think, are looking into doing.
Pretty much. All right, Anna, just let me introduce you to that as well. For you, when you look at this percentage, I know before we went on break, you said maybe it's time for us to have that conversation. But when you listen to what Faith is saying that the way the industry is positioned, even if you are a smaller bank with just a smaller number of depositors, really, once you manage your business properly, your balance sheet at the end of the day is going to make sense. Should we leave it there, knowing very well that the CBK has said they are not going to let a bank go down under their watch?
Yes, I do agree. As much as yes, you're a small bank and you know how to manage your assets and everything, yes, you can survive. But I also do agree with George. Kenya still remains overbanked.
Yes.
Even if we look at other nations like South Africa and Nigeria, our ratio is way too high at around, I think, 7%, given that we have a lot of bank in comparison to the number of population, and
yes.
also COVID exposed a lot of weak banks. We've seen HF this quarter. They opened. They actually asked investors who want to invest so that they can pump in liquidity. So you see, as much as yes, you're a small bank, you are prone to a lot of attacks, a lot of instability. As it had been said before we went to the break, big banks have the leeway to diversify their portfolio.
Yes.
But small banks, given that even you as a client, you will prefer to bank with a big bank than a small bank, since you know that it can withstand the pressure. It can, whatever happens, it will still be there. We've seen Imperial Bank being liquidated. We've talked about Spire, Chase Bank, etc. So yes, as much as yes, you are small and you know how to take care of your assets and everything, small banks are still prone to attack. Small banks are still, whatever happens, let's say if the Omicron does come, I don't think the small banks will be able to survive another year of high provisions, poor asset quality, etc. So it's up to CBK, yes, to put more pressure and to encourage consolidation in the sector,
yes.
so that Kenya can have small but strong banks, compared to the other economies.
Pretty much. All right, Arnold, clear that conversation this morning. Just before we look now at where this growth for this particular banks are coming from and question growth vis-a-vis what the CBK and the government really wants that growth to look like within the economy. Arnold, your point on why you stand on either Kenya being debanked or being overbanked presently.
Okay, so I'm looking at it from two perspectives. Perspective
yes.
number one, the reason as to why a lot of small banks came in is because of that aspect of the mass market, which the sentiments or the feeling is that that aspect or that block of the market was not being properly assisted.
Yes.
If you go back in time, the minimum amount of money you would need to have in an account was about 10,000 shillings, which was a lot of money. And this was at the beginning of the year 2000 or something. And then Equity Bank sort of changed that narrative by essentially ripping off all the banking rules at that particular point in time, and
yes.
including the mass market, and to a big
yes.
extent, Equity Bank are where they are because of the mass market.
Yes.
Of course, there's an aspect of high risk as far as the mass market is concerned, but how do you place yourself in such a way that you can mitigate that risk by customizing credit facilities or financial solutions for this particular part of the market? And that's
yes.
why you see Kenya having a lot of quote-unquote alternative solutions through smaller banks or maybe credit-only institutions. So if you look at it from that particular perspective, that aspect of having a lot of banks or quote-unquote being overbanked as a country,
yes.
vis-a-vis the population, is because of certain needs not being met. If you go to a conventional commercial bank as an SME client, the bureaucracies involved for you to get a facility, in most cases, certain thresholds are not viable or cannot be met by some of clients in the SME market. So these clients opt to go to somewhere where credit is expensive but is quickly available. So unless those aspects are quickly addressed,
yes.
then the question of us having more resilient banks vis-a-vis banks which seem to understand the needs of the client will prevail. Now, technically speaking, as far as the industry is concerned, having less banks with more capital is good for the economy, of course, because of resilience, because of capital adequacy, because of capacity to absorb shocks in the event anything happens in the economy. It is good in that particular aspect. But in terms of addressing the biggest chunk of the economy, we may find ourselves in situations whereby we have few banks, but then again, we have a lot other alternative options cropping up into the market. Credit-only credit-only institutions, mobile lending institutions, and so on and so forth. We've seen CBK and, of course, certain legislative measures being taken to again curb institutions which are lending via mobile. But then again, we may need to relook at the needs of the economy vis-a-vis what the banks are offering. And that's why you'll see, as alluded to by Faith earlier, I think corporates are well banked.
Yes.
Certain elements of the economy are well banked, but what about the mass market? If we can be able to roll out and properly implement things like STAWI, the Credit Guarantee Fund, then it will be a viable discussion. However, if we don't, on paper, it will look good. On the ground, things will be different.
Yes. All right. Now, let's then talk about that growth. And I would like to start with you, Abraham. Let's talk about it. Yes, indeed. When you look at core capital and total assets to total risks weighted assets, that's a very important ratio, especially when you look at where the banking industry is. Then you would say it has been at 16.5 and 18.9% to June 2021. Quite healthy, especially when you have to compare that it has to be at 10.5% and 14.5%. Then you will say, yes, we are fine. I mean, when you look at that ratio, we're good. But then let's talk about where that growth is coming from. It's fine, Abraham, that we're saying, well, the banking sector has been quite resilient. But one big issue is that public debt has been growing throughout that period. Now, but then again, you look at the back end of that, interest rates have remained low despite this rising public debt. Then you ask yourself the question, have the banks benefited from this? Indeed, yes, they have. Because when you look at exactly the liquidity, the hold in terms of treasury bonds and bills, 71.1% in terms of the assets that account for the banking industry as of June 2021. Quite huge, Abraham. Is it therefore time for us to say this growth should be questioned, essentially?
There's several numbers you need to look at. If you look at the liquidity ratio,
yes,
it's at an average, it's above 40.
Yes.
That tells you there are banks probably who are at 60 and others maybe who are at 30. That's why they average about 40.
Yes.
CBK only requires 20%. At 20%, you'll still be within CBK. Is liquidity enough to meet your depositors as they come through?
Yes.
Now, out of their total liquid assets,
yes,
70% is bonds and is treasury bonds and treasury bills. So it means that 70, that amount, either in percentage or in or in absolute terms, should have been lent out, ideally, if you look at what a bank should be doing. So, but that amount reflects as an asset.
Yes.
So there's growth in the asset portfolio, but that amount is starved of the market because that money was lent to the government. If you take that argument further, the government's domestic debt or debt overall is growing. It's now at 8 trillion.
Yes.
Split half for external, for internal. So the question is, if such a big portion of bank assets are in treasury bills and bonds, that means it's a very easy, it's low risk and it's quite some good return at a very minimal effort.
Yes.
But how sustainable is that? Because and where is that money coming from when you think about it? That money is coming off from me and you because the government pays all the money that the government has come from taxes.
Yes.
It doesn't come from anywhere else. Of course, a bit from borrowed funds or from grants.
Yes.
But most of it is from taxes that KRA collects.
Yes.
So this model, as much as banks are here to make money, the issue of it, from where I see it, is how sustainable is this model? The sustainability of it, in the sense of one, for them, having this customer who they're able to, who wants to grow their debt endlessly. But how long will this last? What happens when the government doesn't have that kind of appetite? Then what? Then there'll be a wash with all this money.
Yes.
The challenge normally happens if you do something for so long, you normally forget what you used to do. So the day this money sits with you, then again now you're going to panic mode because you'll be sitting on high, because the higher the liquidity.
Yes. Because
don't forget it's a very delicate balance because these funds cost money. So you have to pay someone for them, the deposit. At the same time, you have to lend it or do something with it to make a margin to pay this person and have a return for your shareholder. So in a nutshell, for me, that model, first of all, that banking model as it is is not very useful to the economy.
Yes.
Simply put.
Yes.
It works well for the shareholders of the bank. It works well for the management of the bank, but does not work for the economy. However, banks are not here for the economy. Banks are here to make money. They are like any other business. So we cannot put that on them. However, it's now upon the regulator to come up with regulations and policies that drive that liquidity away from government towards the private sector. But again, this is now a different conversation from this table, because it again beholds on the government of how it is handling its fiscal and its monetary policy.
Yes.
To ensure that the rising debt levels are managed,
yes,
so that they start staying within whatever they have and freeing this money to come back to the economy as lent funds, especially to the MSME. Because the way it is, for every shilling that goes there is a shilling that comes from here.
Pretty much. All right, George, I want to rope you into that conversation as well. I mean, when we look at this data, especially when you look at it up to June 2021, George, deposits made 74.8% of total banking sector liabilities and shareholder funds at a time when, if you look at those liquid assets that banks will actually have, 71% of that is tradable treasury bills and bonds that were held by banks out of June 2021. George, a time when, I mean, you like to think that we're having this conversation about how 2021 growth of the economy has corresponded to the growth of the banks. But George, going by this data, you might say that indeed it's not the case, because it looks as if when banks are enjoying the low interest rates that the CBK is setting, it looks as if we are opening up an avenue to lend more and more to the government. It's a sure bet for banks, even at a time when we celebrated the cash reserve ratio being reduced to 4.25%. George, should we celebrate some of these intervention measures that have been geared to sort of supporting the banking industry, but now they look as if they were opening an avenue for the government to get more money? Because on the other side of that, public debt has been rising, George.
Elijah, thank you. I think sometimes you are tempted to say that probably the 2021 or 2020 profitability and then 2021 Q3 growth for most of the banks in the industry is cosmetic, so to speak.
Yes.
But I think that is how the economy was then, and probably in the last few quarters.
Yes.
If you look at the CBR rate at 4.25%, that I told you pushed a lot of liquidity back into the banking industry. Same to the repos. The repo agreements that were increased to 28 days, 91 days. So central bank essentially gave a lot of liquidity to the banks. And then on the flip side, the treasury bills were trading at between 7.2% to around 8.5% over the last I think 1 year or 1 year and two quarters.
Yes.
And coupled with the appetite that the government had for borrowings, especially in the domestic market, because that's what we're dealing with, then it tells you why most of the tier 1 banks made very easy money within that period. And then remember, Elijah, that last year the growth in loanable funds last year was very, very minimal. I think it was around 4.25%
yes,
for the whole year. So that essentially means that the commercial banks had a lot of liquidity in their treasuries that they were not willing to push to the private sector,
yes,
but push to the public sector. And then you know that public sector debt is almost risk-free. So it is just monies you picked from client A, B, C, and D and give to government and expect returns back. But maybe that is not going to hold in the next few quarters, in the next few years, because already government is already overborrowed. So maybe the latitude they have to borrow is not very huge.
Yes.
And also, of course, the treasury bills rate are likely to go higher as public debt piles. So that is a strategy that might have worked in the last 1 year,
yes,
in the last 1 year, 2 quarters, but it might not work in the next few quarters to come in. So I think banks must start again thinking on how to push loanable funds to the private sector as it used to be, because then again, Elijah, that is what spurs economic growth in the economy. You don't grow the economy by lending to government, because then government is always just consuming. So I think in the next 2, 3, or 4 quarters,
yes,
the banking industry will want to try to push as much credit as possible to the private sector, so that it spurs again the economic rebound in that space. But if they stick to just investing in T-bills and T-bonds, then maybe that's a short-term strategy, but not a long-term strategy, Elijah.
pretty much. All right, Faith. Now let's start with that word, cosmetic. I mean, if you go to exactly how that growth has been. Remember, we said, yes, you might say they have been resilient looking at the numbers. But then when you look at where those liquid assets are, to the tune of 71.1%, and then when you look at all the policies, Faith, that were quote-unquote supposed to come in and support the economy and make sure that the commercial banks in the country remain afloat, it's like they open an avenue to lend to the government, Faith. So should we question this growth and probably go back and say, maybe not resilient, because public debt is now a big concern? We saw the other day, just before we closed 2021, Okuri Atani saying, if he says that everything is correct or right in the way that the government is borrowing, he will be lying. Meaning, whether we like it or not, we have to change that strategy. So if we change that strategy, Faith, in 2022, are we going to look at banks again falling down from resilience to where we were back in 2020? Faith, please respond.
All right. Thank you, Elijah. And I wouldn't question the credibility of the central bank from a supervisory perspective,
yes,
by agreeing with the cosmetic implied by our friend, George, rather. Yes. So we want to believe, yes, there is some rigorous supervision and audit that goes into the numbers to give it some credence. But that said, like you say, certainly the focus on government security is not long-term. This was a knee-jerk reaction. Yes, historically, if you look at the portfolio of banks, we do not necessarily invest just in loanable funds, rather in loans, lending. We still have very active investment space, which government securities now will fall into that category. We still have a very proactive payment platform, which now accounts for almost 30-40% of banking sector income right now. So we are still allowed pretty much to invest in government securities. Remember, for banks, liquidity is very paramount, and any investments in government security count as liquidity in the banks because of the ease of offloading these securities in the event that there is need for it. So banks strategically will still invest in government security, of course, for that liquidity aspect.
Yes.
But if government borrowing does not go down, and honestly, we do not expect it to come any soon. And ideally, we expect a lot of it to be from the domestic market, considering the volatility that we're seeing in the external market. And if the US, of course, goes ahead to raise interest rates and dollar continues to surge, then there's every reason not to go external. And the concentration on the local market then provides more opportunity for banks to make more money, easy money. They keep saying, like, lazy banking, you put your money in government securities, go tee off at some golf club and come back, you've made 13-14% return on a 20-year paper. So unless, of course, government is very deliberate, and we've seen this succeed in countries like Tanzania, where fiscal deficits are as low as 3% of GDP, if not less. So banks have little alternative to sort of push this money to the private sector, or alternatively pay out to some other elements. Like, even if you're paying dividend, then you're injecting some liquidity back into the market. But for as long as we still have that level of government borrowing, we do not expect banks to. They'll still be have that avenue to lend to government security, and the incentive then to lend to take the risk on the private sector remains extremely low. So as banks, we are very keen. Of course, the private sector provides a lot more return because it's a high risk, high return. And we also acknowledge that there is still some lagged effect, call it, of the interest rate controls. If you realize most banks are still not pricing their assets above 14-15%, although we've seen some slight adjustments to that, and we still have sort of to go to the central bank for any approval to adjust pricing.
Yes.
So in that case, we'll still see banks being a lot more cautious in extending credit because they cannot price it as they believe, at a rate commensurate with the sort of risk and monitoring that's required for this high risk portfolio. And as Anne mentioned, we're still pretty much exposed to the pandemic, so the uncertainty is still there. We are hopeful that Omicron will not be as bad as the Delta variant, otherwise it will already be evident right now. I think also the narrative from the key sectors is starting to sort of tone down and indicate it's the initial fears were overblown.
Yes.
So if that is the case, then we should expect more push for banks to lend to the private sector. Ultimately, we have to see some organic growth, and therefore this remains very central to our strategy. And we are big on mass. That's where everyone has Shwari, KCB, M-Pesa. That is how we are banking the mass right now. There will be more focus towards that because considering just the scope and the sort of the size of mobile lenders in the market, it just goes to tell you if you can have a structured bank penetrating this market, as opportunity within the Kenya banking sector.
Pretty much. All right, and let me also have you weigh in on that conversation. And the meaning of resilience, does it change when you see that composition of liquid assets, 71.1% treasury bills and bonds, Anne?
I think the government really did provide an avenue for banks to invest in them.
Yes.
Remember in the 2021-2022 budget,
yes,
they adjusted the public debt to foreign debt mix. Now public debt comprises of 70.8%
yes,
versus 29.2%. So with that, and also with the credit risk that was last year, banks put more in government papers, they put more in treasury bills and treasury bonds so that they can just de-risk their portfolio. Remember, lending out to loans has a lot of risk than non-performing loans. Other people will default, but giving to a government papers are perceived to be more secure. They know that as even in 1 year, 2 years, they'd still be there. As much as we have a country like Zambia who defaulted on their Eurobond, but for these short-term papers, banks have a higher or a positive outlook, and they know, as it had been mentioned before, if I put in a 91-day T-bill or 182-day T-bill or just 4-day T-bill, I know in 1 year I'll have that money, I'll have that liquidity. It's easy to liquidate short-term papers. So for now, banks will continue to invest in government securities, but as the conditions improve, as the environment improves, now we'll see more lending to the private sector. But then again, even with the CRR that was reduced to 4.25% last year,
yes,
we've not seen growth in the private sector. Banks still perceive private sector as a risky adventure. So you'll see them now again going to government securities just to de-risk their portfolios. But should the economy improve, should the macros improve, we'll see banks, as we've seen actually in this Q3, for the listed banks that we track, investing in government securities actually grew at a slower rate than than giving out loans. So should the macros continue to improve for next year and in the near term, we'll see now banks continue now to go back to the sectors in the economy.
Pretty much. All right, Arnold, in just a couple of minutes, two if you can, banks are in the business of business, so we should bestow them with the responsibility of growing the economy. It's just that it.
Okay. Okay. Obligations to shareholders, aspects to do with profit. So we're likely to see banks, as alluded to by my fellow panelists, continue to lend to the government. However, I think we may need to also factor in certain interventions which have been made by regional and international bodies. I earlier alluded to what European Investment Bank is doing with CoopBank. It's essentially just to try and push credit to SMEs, and we've seen a couple of more such initiatives being pushed into the market. I think one thing we may also need to consider, even as we continue to extrapolate this particular discussion, the SME market, what banks have also done, apart from just lending to the government, we've also seen a lot of profiling of clients, classification and profiling of clients. So certain aspects, certain parts of the economy will still get credit based on their performance and based on their projections. However, I think we may need to, as an economy and as a banking, as the banking sector, we may need to properly implement intentional items which have been placed to aid the SMEs. And as I alluded to earlier, the credit guarantee scheme, the STAWI initiative, and also such initiatives which are being done by the European Investment Bank in conjunction with the likes of Cooperative Bank.
Pretty much. All right. Now, let's get close to the end of this conversation like this, therefore, Abraham. We've looked at 2021. We've seen where the growth was. We've seen the emerging issues around that area. So let's look into 2022. Big ones as well. Now we do know that any other person who has defaulted a loan of 5 million shillings and below will not be listed by CRBs within the economy, meaning up to September 2022. That's when effectively you can blacklist or confirm or check with a credit reference bureau on whether Abraham or Nsimba are good borrowers or not. That is an emerging issue. Another one is the impending general elections 2022 as well. Let's talk about the first one, Abraham. Is that going to be an impediment, therefore, to lending to the private sector or the mass market? And if not, or yes, what do you expect? How do you expect the banks to behave within the spirit?
No, it will affect. And I think it has already started to affect, because what basically you've done, you're asking the banks to shoot in the dark. So and banks like certainty.
Yes.
So you'll definitely see a lot of shying off from that sector.
Yes.
At a personal level.
Yes.
Compound that with elections. This is a year where banks will play it very safe. So if there's again, and as much as we talked about it at length, if there'll be room to lend to government, they'll lend to government.
Yes.
You see, they rather keep their money liquid or near liquid, and avoid as much as possible, especially this debt now where they can't check your credibility in terms of CRB. Yes, the measure was well meant, but you can see now the banks will look at it again from their side.
Listen, Abraham, I want to ask you that question as
Yes.
well. Did it appear funny to you that when the Central Bank of Kenya Governor, Dr. Patrick Njoroge, was officially starting that moratorium period for blacklisting for anybody who's defaulted a loan below 5 million shillings, he did warn that this is bound to take us back to where we were in the cap rate regime? Did it sound weird to you that this is a policy that didn't sort of meet the policy making process?
You see, it was well meant, but again now it was well. You see,
Abraham, a well-meant policy means that you actually talk to the policy makers.
You see, my brother spoke of banks profiling.
Yes.
So people had developed bad profiles based on a very abnormal year.
Yes.
So basically what we're trying to do is to see if we can put them to the period prior to this pandemic period. Because there are people whose profiles have gone very bad, but they're not bad people from a credit perspective. So that's what it was meant to do.
Yes.
But now what eventually it will do is, since there'll be starvation of credit to these particular people, then we'll see an emergence of a black market. That's for sure.
Yes.
And that black market will come in all manner of forms. Of course, the loan sharks will have their field day. As much as we want to regulate the digital ones, what about the non-digital ones?
Yes.
And those are the ones that exist a lot. So we'll see a lot of that, because credit is needed. And credit has two aspects, price and access.
Yes.
Access comes first. So when you can't ask access, then people become price insensitive.
Yes.
That's why you see people taking loans of 30% per month because I need the money.
Yes.
But once access is crossed, and that's where I think we had reached. That's why we had started having the discussion of price. But now we are back. We are back to now an access issue.
Yes.
And that will play out in this election period until that moratorium ends. And the moratorium will end in September when there'll be transition. So we'll talk about normality on this particular issue probably at the end of the year.
Pretty much. Yeah. All right, Faith, let me jump to you as well this morning as we weigh into the emerging issues that are taking us all the way to 2022. That particular policy, the moratorium for blacklisting any other person or any other business entity within the economy that has defaulted a loan of less than 5 million shillings. Well intended, but can I get your sentiments on that, Faith?
It's certainly well intended, but even from an NCBA perspective, we have literally over 200 billion exposure right there, and that is pretty much your insurance portfolio, which is quite huge.
Yes.
But strategically as a bank, and I don't know whether this is across the board, but I think that is a conversation happening at KBA right now.
Yes.
Strategically, we've decided not to freeze lending. There are other avenues from which you can determine a viability of a customer. Yes, the CRB sort of disincentivizes people to service their loans, and could mean like us extending credit to that segment is a lot more risky. But there are other initiatives that banks are sort of taking to make sure we do not freeze lending.
Yes.
So we are not too exposed to the risk that indeed presents. So there's some fair balance that is likely to happen. I think it pushes for more innovations on the banking side in terms of that's how we determine the viability of each person in terms of how their serviceability of debt. And it should make for a better 2022. With all this, what COVID has basically done is test our business models.
Yes.
Push us to sort of towards better innovation, towards more efficiency. And that is what should drive sustainability in 2022 and beyond.
Pretty much. All right, George, I just want to get your sentiments on that as well. It's a big one, it's a big policy that we did see Uhuru Kenyatta push to the industry on the Mashujaa Day celebrations, that non-listing pronouncement for any other individual or business entity who has defaulted 5 million shillings and below. How do you foresee the industry is going to react within that policy, George?
I think, Elijah, that is a good thing. If for example I was not able to pay my facility last year,
yes,
because of the COVID-19 ravages, the COVID-19 risks,
yes,
then if you close my credit tap, so to speak, then you close my avenues of restarting my business or revamping my business. So that essentially what the president did is at least to give a pathway for most SMEs, because most SMEs are the ones that are affected in that space, to at least get credit that they can use to pump back into their business and at least get back to where they were pre-COVID-19. So I know that is short-term, yes, but it is a good thing, and it is going to at least revive most of the SMEs that otherwise would have gone under with the COVID-19 pandemic. I think Mudhoga alluded to that most SMEs just didn't go down in business, but some of them actually closed because they were not able to sustain the COVID-19 pandemic risk. Yes. But at least with this, they have a pathway to restart their businesses again, so that they can recover to where they were in 2019 and pre-COVID, Elijah.
Yes. George, just before I let you go on that, you're taking a slightly different perspective from what Faith and Abraham have actually spoken about. But then the banks, George, if you were a banker now, is that not somebody telling you, well, you got to lend in the dark. You have to be sure who you're giving your credit to.
Not actually, Elijah. The way listings are done, the only thing that is changing is that I'm not going to be listed as, I'm not going to be given a negative listing. Otherwise, all loans as they are today, Elijah, are listed with the Credit Reference Bureau.
Yes.
So if I had a loan of 5 million and I defaulted, the only thing that the president did is that I'm not listed as a negative on a negative scale.
Yes.
But still, that facility is still in my CRB records. So for a banker who is looking at my credit history, they'll want to know this facility, what did you pick it for? Did you manage to pay it back? If you didn't manage to pay it back, what were the reasons? So that forms part of their due diligence procedure as they look into giving me a second or third facility, Elijah.
Yes, pretty much. All right, quickly, let me cross over to Anne. Anne, a big pronouncement by President Uhuru Kenyatta on Mashujaa Day celebrations. Looking into the industry, how do you expect them to react in 2022, Anne?
The directive was a really good move, more
Yes.
so to borrowers, given that they know they now have more time to repay their loans and restructure their loans.
Yes.
But if you look at the banking perspective, as George has said, banks will now have to be more proactive, given that, yes, your loan is still listed, but it will be hard for banks to distinguish between good loans and bad loans, given that they can't really see from their end if you've defaulted or anything. Now they'll have to come up with new structures, with new measures, just to know, just the due diligence part of it, they'll have to improve it so that they can know if I'm lending to X and X person,
Yes.
do they have the ability to pay it back, or will they default in the near future?
Pretty much. All right, Arnold, clear that conversation this morning. I know I spoke to you when that pronouncement was made. Arnold, have you changed your view that probably this could be good for the economy?
I think I still feel it was a roadside declaration. But at the same time,
what you used when we spoke.
Honestly speaking, at the same time, simply because of the practical aspects of dealing with such declarations.
Yes.
Now, I resonate with what Anne is talking about. It simply means as a bank, you may need to enhance your appraisal tools when dealing with such clients, because
yes.
any sort of blanket declarations leaves leeway for so many possibilities. And for prudential lending or facilitation of credit facilities, you only need to further look into your appraisal tools. Again, the effect it will probably have on the ground, I don't think banks will just take it up quickly. Banks will still be very cautious. And based on the discussions we've been having this morning, we'll still see a lot of these banks just being cautious on how they deal with such clients. So a good move on paper. And the intention is to basically just to try and avail credit to the MSMEs or clients who may fall into that particular bracket. But at the same time, the onus is on the banks to look at the appraisal tools and basically just safeguard their position.
Pretty much. All right, last round. Therefore, as we close 2021, all right. Now, Abraham, if you look at the GDP growth rate in all the way from 2017 up to where we are in 2021, I don't know even whether you have that data for the GDP growth rates, the quarterly GDP growth rate. So we're gonna actually take a look at it, because there's a very important conversation that it will come out of that this morning. Yes, there it is, George. Sorry, Abraham. Because if you look at where we were in 2017, 5.2 went to 4.4. 4.5, and then we went to 5.1. You will say those were the effects of the electioneering period within when we were deep within the elections. Fine, we have that data scored there. The coronavirus pandemic did come in, which was the biggest, which was the biggest threat to Kenya's economy after the election in 2017. And within that, we said the banking industry was quite resilient. But then, Abraham, we've actually seen that indeed there is a big disparity from banking industry performance and the economic growth. Is that what we're looking at 2022? Are we saying that the electioneering period might not really affect much the growth of the banking industry, given that, as it is now, I mean, 71.1% of the liquid assets are within treasury bills and government bonds?
You know, if you look at these numbers over even a longer period,
yes,
there's always a disparity.
Yes.
And the main reason is that banks the bank data, with due respect to banks, is much more accurate than the government data. For this reason.
Yes.
Most of the businesses in Kenya are not documented, but they are banked.
Yes.
So they don't appear on the economic radar, but they appear on the banking radar. So the performance of the banks is as a result of the interaction with the economy as a whole.
Yes.
Our economic indicators, because the models we use, of course, are models that are World Bank models, IMF models.
Yes.
Are very driven by, are data heavy, are driven by data and how data is collected. We all know that how SMEs operate. Some of them are completely below radar. So that's why you see that, because ideally those two numbers should be very close to each other. Because don't forget, banking is a pulse of the economy.
Yes.
Because that's where all the birds come from.
Yes.
But for this particular economy, because of the informality of it, probably up to 50% of it could be below radar in terms of being counted.
Yes.
So the banking performance, as you can see, during this period, it went up and down.
Yes.
And because it had a pulse on the economy, because every SME, no matter how small, they are banked in one way or the other.
Yes.
That's how well bank people are. But when it comes to the economic collection data, most of the people are not counted in terms of what they're doing, what they're up to, how much they're making. But banks have a clear indication of how much you're making, because they're the ones who keep it for you anyway. So for me, I would, if I was to compare those two data, I would rely more on the banking data than on the economic one.
Pretty much. All right, let's take the last round of response from you, Faith. And then, when you look at that economic, that is the GDP growth, the growth data, and then how the banks have also grown within the electioneering period and the COVID-19 pandemic period. Faith, should we worry more about COVID-19 or the electioneering period? Quickly, if you can, so that we wrap up.
All right. Thank you, Simba. The relationship between banking and the economy is like the cat and mouse. Sometimes you don't know which one comes first. The banks do benefit from a strong economic environment, but they also propel economic growth by availing credit.
Yes.
So should we worry about the Omicron or the electioneering period? Statistically, and I have looked at the numbers, honestly, there's still there's no clear evidence to suggest that indeed activity slows down during elections. Sentiment tend to suggest so, but statistically, you cannot prove that. And I looked at this quite recently. What happens as the election environment shapes up? Of course, investors will adjust to how it's playing out and the likely outcome. It sort of helps that we have stronger institutions today, where we have some fair confidence in the judiciary in sort of resolving any election discourse, and therefore that confidence helps when planning for any investments or consumption for that matter. And I think as a people, we maybe this is biased, but we are so much tired, and the COVID period has been so difficult. We just want to move on with our lives. How election play out, at the end of the day, I just need to know how I'm going to get food on the table.
Yes.
So the election have an impact on growth for bank, of course, and the economy generally. It should just some slowdown. What it happened, it probably could delay some investment, some consumption, but this should certainly come back, and a lot more strongly once we have the new government in office. I do not expect we'll have a chaotic transition. And that, I believe, should be good for the economy generally. And certainly, if the banking, rather the economic environment is stable, if sentiments are optimistic, then certainly the banking sector could as well ride on that. So certainly, I'm very positive about 2022. Unless, of course, the Omicron is much worse than the Delta variant.
Pretty much. All right, we have less than a minute. George, let me get 30 seconds response from you. What should we be looking forward to, the general election or the threat that the COVID-19 pandemic faces the industry with?
I think Elijah, COVID-19. I think we've coped with it quite well. If you look at Kenya vis-a-vis our compatriots, if you look at the global economy, Elijah, the global economy contracted by 3.2%. The more advanced economies, that is the bigger economies, contracted by a whopping 4.6%. Sub-Saharan Africa contracted by 1.8%. Yet Kenya grew its economy by 0.6%. So that tells you that Kenya, as an economy, is resilient as it one, and we expect a growth rate of around 5.4% this year. So I think in terms of COVID-19, we are at a space where I don't foresee the risk is still there, yes, but I think it's a risk that we can manage. My only fear, Elijah, is that we are going to have two major risks in the next 3 or 4 quarters. That is the COVID-19 pandemic, especially the Omicron variant, and then our election that is coming up. Our election has been a bit of a challenge over the last few cycles, but I believe this one will be much better than what we've had before. If we can be able to manage those two, Elijah, then I believe we're in a safer space as we go into 2022, Elijah.
Pretty much. And 15 seconds from you. COVID-19 or the election in 2022?
For me, I think banks will be more concerned of the variant, given that COVID-19 was actually worse than the environment that it put Kenya. It was worse than any election.
Yes.
So for banks, they'll be more concerned about just managing the pandemic. Yes, the two risks will coincide, but banks will be more concerned about how the variant will affect their books.
Pretty much. Arnold, clear this 2021 conversation as we look into 2022. 15 seconds for you. COVID-19 pandemic or the general election in 2022 that generally just shakes the Kenyan market?
I think we may need to assess both, but I feel that we will do better as far as adjustments with COVID-19 are concerned. So I think the focus will be more on the general elections and the impact that it has on the economy. My take.
Fantastic. At this point, let me say thank you very much to Faith Atiti, Senior Research Economist, NCBA, George Munga, Economist and Analyst, and Managing Partner, AMG Kenya, Anna Wasera, who's an Investment Analyst, Saiton Investments. We have Arnold Nkosala, who's a Microfinance Banker, and Abraham Mudhogom, who's a Financial Expert and CEO, Mirwadi Capital. For us here at Metropol Television, we wish you a very, very, very Merry Christmas and a prosperous 2022. Good morning and goodbye.